Hello and welcome to this week's Quick Take with AFE. My name is Ryan Forster and this is my twin.
I'm Alec Bethurm. Matching coats today.
So,
not on purpose.
Today we're going to spend a little bit of time unpacking IPOs because that's if you're buying an index fund, the companies within the index fund at one point became a public company. So the initial public offering is the liquidity event for the company, but also it's the way that most investors get access to the public capital. So, Alec, why don't you dive into a couple of the things that are the themes as far as where are companies, at what capital level are they coming to their IPO, and what is the excitement that we're seeing right now?
Yeah, so it's really evolved over the years. Certainly in the early parts of the 2000s and late to 90s, the IPO really was more common. A lot of companies were coming public a lot earlier in their life cycle. We've really seen the big evolution of private equity over the last couple of decades. Private equity has been somebody that's been supporting these companies economically kind of in those early and mid stages. Traditionally a company would IPO because they wanted to get access to the capital in public markets. So that was really how they expanded, whether it was through acquisition or whether it was through, additional factory capacity or something like that. Today that's really been supported a lot more by private equity type firms. And, the reason why that's more attractive or has been more attractive to management teams is, one of the only negatives about going public is, you're under a lot more scrutiny. All of your financials are now public. Your competitors are aware of what your margins are. There's certainly more regulatory scrutiny of a public company. So they've been kind of advantaged to stay private longer because there's actually capital been available. But we're starting to see that change a little bit here in just the last couple of months. Certainly there's a huge demand for capital with the AI build out. And so a lot of companies now have started to look at tapping the public markets, particularly even outside the United States. There's been an explosion in Hong Kong of AI IPOs in the last, couple of months kind of thing. So certainly that's starting to change and starting to evolve. And there's some big ones coming here domestically.
So the thing that astounds me is as you look at the size of the company, because we used to see IPOs, a unicorn was $1 billion. Now a unicorn's $1 trillion. The absolute scale of them. What do you see with the small companies?
Yeah, so one of the things that Ryan's talking about and that's important and that has evolved is that, there hasn't been the ability for public investors or investors like us to get involved in some of these companies at the early stages. And so I think a lot of concern out there has been that a lot of that initial appreciation from the kind of hyperbolic growth phase of a smaller company, a lot of that benefit hasn't necessarily accrued to retail investors. It's really accruing to some of these private equity firms and something like that. And I think, you were going to talk about some of the returns. People think that these IPOs, by their very nature have explosive returns. That's not necessarily the case. And I think that's a little bit of a misconception out there.
Yeah, the thing that right now IPOs are more selling the sizzle than selling the steak. It's the idea that this company can perform. So one of the big IPOs that's coming here in the next few months, they've got decades of earnings. Was it coming out of 25 earnings? And it's hugely retail invested, and it's coming in as one of the top 10 largest companies in the world. Yet it doesn't have anything public until this IPO. You see a lot of small companies that they're going to have that growth, which is why we see a lot of small cap index and small cap managers. Historically, 20 years ago was a great place for extra performance, especially in a recovery, but we just haven't seen that. A lot of the times it's the private investors can get a lot more value as the company grows. But let's talk about the sizzle a little bit. So when there's an IPO, now you have access to it. And so it gets really exciting because, hey, now I can finally buy that thing that we've been looking at on the news or we've used on our phone or whatever it is. The truth of the matter, if we look at median returns over the last 10 years, it's usually the fanfare is the first, week to 2 weeks?
Yeah, certainly. Or even kind of, now there's even kind of pre-IPO. And I would almost tell people that that's something to be careful of because we're seeing it come across our computers constantly where, different, so-called strategies or investors claim to have access to certain of these deals kind of pre-IPO. And, all of that has kind of worked its way through the system already, kind of thing. So I would certainly be careful of anyone pitching you to say, oh, we're going to get access to XYZ company or that company pre-IPO, when we're at the latter stages. Now, if it had been 4 or 5 years ago, that's a different story. But at the latter stages, when people are just kind of pitching these investment ideas, I would certainly be, kind of run, don't walk away from those situations.
Yeah, it's the first ETF to have this exposure. The fierce mutual fund intervals have that, and we dig deep into the balance sheet, into what they're actually doing. There's a lot of them that they don't even have direct exposure. It's through a special vehicle. And like you look at their year-to-date returns, and they're absolutely horrid. And with companies that are supposedly doing really well, why would an ETF or mutual fund be doing poorly if they had such great exposure? So there's always so much more to it, and companies try to capitalize on that sizzle. So the median return is really not that great. On average, over the last 10 years, it's been about 5 to 10%. U.S. companies going to IPO has been the return. This is according to Jay Ritter's IPO data in Renaissance Capital. But when you look at when you're going a little bit bigger, over the next month, then the momentum fades, and so the actual return drops down to 2 to 6%. And then,
I think I'd be, we've kind of talked about this. I think I'd be really careful of these situations where you've got sophisticated institutions and you've got people actually managing these companies now selling their shares into the market. And so, these guys are not in the habit of selling stuff cheap. And it's not like some of these companies are desperate for capital because, we can see there's lots of capital out there available. So you really want to be cognizant in these situations of who the sellers are. Is it the management team? Is it guys that were early stage from a venture perspective? And if they're selling stock at these valuations, you have to ask yourself, why are they doing it? Now, there might be very good reasons. It could just be, diversification, liquidity, et cetera. But any time that you see Wall Street, appearing to be extremely generous and appearing to sell, highly valued securities, to the public at some kind of discount, you at least want to take one step back and think about it because, as there's many, many good people in the industry, but, certainly not known for, selling stuff on the cheap.
And I say this on news headlines, on when some manager goes and puts out a post that this is the big thing or whatever, always follow the money. What's the motivation? There's always a financial reason why they're saying or doing or whatever. And with IPO, a big time it's institutional liquidity. And the result of that is 1 year after IPO, when everybody's so excited for this great investment, the median return right down the middle is -5% to 0%. So there's actually not a huge, when you're just getting all of them that hit the market, not a lot of them do really, really, really well.
Yeah, and I mean, that's, that just makes sense, right? Like we said, sophisticated guys selling into the market doesn't mean they're not great companies, right? So we always want to differentiate, which I think we try to do, between the stock and the company. You could have a great company and a terrible stock, and conversely, you could actually have a terrible company and a great stock because it could be so cheap. So you kind of just want to take a step back and realize that as well. Try not to chase the stuff. Try to be cognizant of the idea that if these are truly great companies, they're going to continue to grow into perpetuity. You're going to get an opportunity to buy it. Rushing to buy it when everybody else wants to buy it, or when someone really smart is selling it, probably a good idea to take a step back.
So who's the big winner during the IPO? Who makes the most money?
Yeah, I mean, essentially the management team and the venture guys that were in it, at the early stages of it. Particularly, like I say, when you see that the sellers aren't the company themselves. Like kind of Ryan, you were saying earlier, I'm okay with a small company selling stock to get growth capital because we want it to explode. That's much different than a $1 trillion company selling stock that doesn't even need capital. So that's the other important part of it.
Yeah, so a lot of times the investment banks they make a killing. So
right.
It doesn't mean that IPOs are bad. IPOs are an essential function of our market and economy. So what do we do when we see a really great stock go to IPO? What's our idea? What's our thesis?
Yeah, I mean, I think we just want to take a step back and look at the core business, look at what the valuation is. A lot of times these are businesses that we want to own for the long term, but not necessarily at the valuation that they're coming. And, particularly in this day and age where, like I said, things are coming public so much later, almost very rarely is something going to come public at a really exciting valuation in this day and age. We probably want to take a step back. We want to look for an opportunity and enter the business at a price that's more attractive.
Okay, so just summarizing with IPOs, it is a necessary function. A lot of times they're selling the sizzle rather than the steak, and we like to take a step back, be patient, look at the companies, and make sure we buy them at a valuation that makes sense, which oftentimes is not what they come to market at. So
yeah, and that's exactly right. And oftentimes you're going to get 6 or 8 months down the line a really great opportunity, and that's been the case with some of the biggest names out there. Meta, for example, was down 20 or 30% for the first year. Here we are, 5, 6, 7 years later, up 3,000%. So there's a lot of opportunity in there if you just kind of take a step back and be patient.
Yeah, not that we're recommending any stocks. It's just for instance, on a commonly held stock in an index. So, well, thanks for joining us with this week's Thought. My name is Ryan.
This is out.
And you can leave us messages or comments, and love to chat with you more about the anatomy of an IPO.